Morning, guys. It's Friday, December 12th, 5:24 a.m. Central Time. Grain markets are mixed this morning. Brian Split is here. Brian, good morning.
Morning, Joe.
Stash is coming in nicely.
Thanks, buddy. Appreciate it.
Hey, so your group, Ag Market, is having a big meeting here in Nashville, February 1st. Tell the people why they should attend, what they can expect to see.
Well, I think you should attend because, number one, you're going to have a fun time. I think that'll be a guarantee. But number two, it'll be a couple days of some very good education from all aspects of production, agriculture here for row crops. We'll get some fertilizer information, some good weather information from Eric Snodgrass. Even the CME Group chief economist, Eric Norland, he's going to give a really good 50,000-foot view of just economics as a whole, how the currencies are shaping up and what that might mean for overall commodity values. So I think it's just going to be very useful information for you as you enter 2026, and we're trying to figure out how to make money farming.
We will be doing a live podcast taping, which is a very small part of the meeting, but should be cool. All right, before we get into the news, Brian, I want to show you some charts, and I would like your opinion on the charts. This is a simple version of a March corn chart made by a very simple man. I made this morning, but how do you view this chart?
The head and shoulder potential bottom is still in play. We haven't done anything to negate that. We need to get some consecutive closes over 450 in order to really validate the breakout through the neckline of the pattern. If nothing else, the uptrend that we've been in for the last 4 months is intact. We haven't done anything to negate that either. That 457 high matches the July monthly high, and a push through that should confirm a breakout to the upside. We've only been able to close, above the 200-day moving average 1 day at a time. So some consecutive closes over the 200-day might also be a good sign. But the time of year being December, I would suggest that with this trading range where 440 is the low end and 450 is the upper end, unless we get some type of news, we might find ourselves pretty happy in that trading range for the next several weeks.
Here's January soybeans. You got this big gap below the market that everybody's watching. How important is it that we fill the gap, don't fill the gap? Are we going to fill the gap? What are your thoughts?
That was a breakaway gap, and I don't know that it necessarily has to be filled. If we could catch in this area against some of these old highs that we had earlier in the year, you could go back and even before what this chart shows, there's a February high, then there's your June highs, then your August highs. And so they're going to be coming in this general area. So this would be considered the breakout point where we started making new highs for the year. Again, if we were to catch around 1080, I could see this being an area we try to bounce from. But sub 1080, I think it's just visually the market is looking at this gap, and it shouldn't be a surprise to see us break another 18 cents and fill that.
Just to look at this on a weekly continuation basis, how important is it that we avoid a digestion back into that previous trading range?
Extremely important. And so this, I think, is a really good chart to look at where it shows you where those previous highs were earlier this year, where we broke out through them, and how we are now retesting them. So the problem with falling back into that previous range is just by nature of the range. Once you're inside of it, you may want to revisit the whole range. And so, if we drop back below 1080 in the big picture, then at some point we may very well want to go look at the low to mid nines again, just to revisit the whole trading range.
Okay, we'll look at Kansas City wheat very quickly. We had a rally attempt in November. It has since failed. Is this downtrend going to resume?
Well, so there's a little area of horizontal support, and we've been holding this. So with the exception of that breakdown in October, you could go back to some of those lows in September, and then these lows that we've been holding in November and December at this point. And it's been this 520 level. We've ticked through it a little bit, but we haven't been able to close below 520. I would say that if we were to close below 520, I wouldn't see any reason where wheat shouldn't be trying to revisit the contract lows made in October. From a fundamental standpoint, the global wheat production has gone up tremendously in the last 4 months to the tune of 31 million tons. So it's just a tough weight over the market to try and establish an uptrend at this point. But it's holding in, all things considered, pretty decently with the news that we've gotten.
All right, let's actually get into the news. We have some fertilizer stuff to start off with this morning.
Yep, fertilizer stocks surged yesterday after Ukrainian drones struck 2 fertilizer plants in western Russia. The facilities represent only a small share of total capacity, but the market is now factoring in rising geopolitical tensions that could disrupt fertilizer supply chains. Additional fertilizer supply concerns surfaced earlier this week when President Trump threatened to impose tariffs on Canadian fertilizer to boost domestic fertilizer production. Canada is the largest supplier of potash to the U.S.
All right, I've got a chart we can look at very quickly of fertilizer companies and how they've done this year. Mosaic and CF have not acted well relative to the broader stock market. CF's off 8% year to date. Mosaic is only up 3%. The S&P's up like 17. Nutrients acted pretty well. You guys probably care more about this. So Trump wants to put potentially tariffs on Canadian fertilizer imports, and it's a big deal for potash in particular. Imports from Canada account for ballpark 79% of all of our supplies. Previously, it was like a month ago now, I think, Brian, that the Trump administration dropped all of the tariffs on fertilizer imports. So I don't know. I don't know what the point of this is, but I feel like the administration, if they could do one thing, they might be able to help out with inputs. They can't fix supply and demand, but they might be able to help the farmer out with inputs.
Yeah, I mean, there's a lot of challenges the producer is facing right now, and I think a bottom line again is the fact that everything the producer needs to buy to grow the crop versus the value of the crop that they're selling has been moving in different directions. And so in order to help that situation, bringing down input costs would be a tremendous help. And it's just, there's so much back and forth with this administration of what are we focusing on? How are we helping the farmer? And then just to turn around and do something that, again, at first glance, you'd say, all right, well, this isn't going to help the farmer. This is going to make it more difficult with higher input costs. So where is the focus? Why, to your point, why are we doing this? What are we trying to achieve by doing this?
Well, he talked about onshoring some more domestic production, which is something that doesn't happen overnight or maybe doesn't happen at all. Just for a little bit of context, if you're a U.S. corn grower, fertilizer, generally speaking, is your third largest line item expense. Land would be number one, machinery and equipment would be number two. Your potash expense is only like 10 to 20% of your normal fertilizer bill for a farm operation. So, I mean, if prices were to rise a little bit, it's not the end of the world. It's just, I don't think it's a good look for the administration, again, in the eyes of the ag community, and it's certainly not helpful. Let's go to flash sales.
Yep, U.S. exporters sold 10 million bushels of soybeans to China and 10 million bushels of soybeans to unknown destinations for delivery during the current marketing year yesterday. Exporters also sold 7 million bushels of corn to unknown destinations for delivery during the current marketing year.
The market, soybean market, Brian, did not rally yesterday, even though we're seeing continued flash sales. We're now, I think, at 27% of the 12 million metric ton target. Whenever the date is, I don't really know. What sort of export sales do you need to see to rally the bean market? Because what we've seen so far has just been, we've seen continued selling for a couple of weeks now.
We have. I mean, there was the period where we had the idea that we were going to have the trade deal and that the announcement was made and the market went up tremendously. And through that period, there was some buying behind the scenes. It seemed like as the actual sales were being announced, the market continued to sell that news. And we just haven't broken out of that pattern. So we've sold, you mentioned the sale yesterday. I think the day before we had another combination between China and unknown, another almost 500,000. So that's almost a million tons this week of flash sales. But we have other things going on just besides China buying, and are they going to buy, or are they not going to buy, or how much? We have Brazilian weather at play, and that looks good right now. And so we have the weight of that Brazilian crop coming behind us. I think you have to see sustained Chinese buying. You need to see flash sales every day in order for this market to feel like it's going to not need to go down. We got to build some stability here first and hold some support. But how much do we need to buy? We need to start getting to the point where it looks like we're going to achieve a 12 million ton round of purchases here in very short order. And the pace that we have right now, I don't know. What is the pace? What are we measuring against? February 28th seems like it's the new date. I don't know where that date came from. It's the end of the season.
I think we might be past. I think we might be past like the headline stuff. Like we traded the headlines and the expectation, and now I think we're just back to flat out trading balance sheets like we typically do. And given the pace of export sales, which we're going to get to here in a second, we're probably not where we need to be to hit USDA's export target. Correct. Which means that in the future, USDA is probably going to have to cut that export number. Now, in the same breath, I'll say that I think USDA is understating soybean crush. The numbers have been fantastic. We had some fresh data this week, which would indicate as much. Let's go to the export sales report, which was again backdated, but we're catching up.
Yep. For the week ending November 13th, net corn sales easily surpassed pre-report expectations at 94 million bushels. The print was up substantially from the prior week, with Mexico as the largest buyer. Net soybean sales were near the lower end of expectations at 26 million bushels. The print was up 36% from the previous week, with Germany as the largest buyer. Net wheat sales surpassed expectations at 31 million bushels, which was up 84% from the previous week, with unknown destinations as the largest buyer for the week.
Demand for U.S. corn remains fantastic. And of course, this is backdated, but it's the best book of export sales we've ever seen. Shipments have been the best we've ever seen also. So I guess I'll ask you this, Brian. Like, we've got this fantastic demand base via both exports and ethanol. Like, why is the market just so dull?
Because I think the trade is still thinking, even if there is a yield reduction, it's got to be a really big one because of the feed residual category. I think that with the USDA making an adjustment to corn for export on the December WASDE, that to me takes the export category out of the mix on the January report, where it's going to be a focus on yield, and it'll be a focus on making an appropriate revision to the feed residual to accompany a yield revision lower. Now, historically, and we should have already seen this, typically when you see a miss like we had on the September stocks report, which then shows a reduction in the feed demand from where we thought it should be, they usually will go into the upcoming crop and make the adjustment to feed residual accordingly there, and they haven't done that yet. So that category is still going to be the one where I think this market's saying, yeah, the crop is probably smaller than where the USDA told us in the last WASDE, but the demand is also going to be smaller. And I think the market's just reluctant to really do much until we get a solid handle on what the USDA is going to print in about a month.
The way I see it now is it's going to be tough to get that carryout estimate below 2 billion, because if they cut the crop, they're going to cut feed residual by a similar amount, and you're going to end up with, a similar carryout estimate. Here's soybeans, and in real time, this is better, but it's still going to be one of the worst books of export sales of the last 10 years for sure.
Yeah, without a doubt. And a lot of this, if you look at the, how much we're running behind the pace of where we should be according to USDA, and a lot of that has to do with just simply the size of the last Brazilian crop. If you look at year over year increase from 154 million tons up to where are we at right now for Brazil's crop last year, 171 and a half or so. That's a stark increase year over year, and that increase year over year is about how much we're behind our current pace. Now, why the USDA hasn't made the revision lower on our soybeans for export yet, that's a great question. I think you could probably say that there's better pace analysis to make an adjustment lower on soybean export demand than there is for increasing corn demand, but yet that was the choice that they made.
Yeah. Here's wheat. Best book of the last 10 years, best book since 2013. You wouldn't know it by looking at the market, which has really struggled.
Yeah. And I would say that this is another one where you could say USDA should have evidence to increase wheat for export on the balance sheet based on the pace that we have right now. But it, to me, also seems like maybe they're not doing that because of the amount of they've increased the global production. It's telling us that additional export demand won't be coming our way because of increases in global production.
Let's go to Brazil.
CONAB lowered its forecast for this season's soybean crop yesterday. The agency slightly reduced its outlook to 177.1 million metric tons. Still a record crop. The downward revision reflects a lack of rainfall in some areas during November, which led to the replanting of some fields. As of early December, roughly 90% of Brazil's soybean crop had been planted. CONAB estimates that a portion of the crop will be ready for export by early January, with total exports pegged at 112 million metric tons.
177 is still a monster. I don't have any reason to believe that like we should be really concerned about Brazilian production right now. Rainfall over the last 14 days has been above normal on average across Brazilian soybean areas. Great data from our friends at Crop Profit. Forecast for the next 7 days, 140% of normal precipitation in Brazilian soybean growing areas, although far southern areas and Argentina are going to be drier than normal. And then you go to 8 to 14, above normal rainfall pretty much everywhere, with the exception of some areas of Argentina. Have you heard anything to the contrary, Brian? Like, is there any reason to believe that there are crop problems in Brazil right now on a large scale?
I don't think so. No, I mean, there was a period where I think some of the weather entities were talking. If there was going to be some above normal temperatures and some drier bias, it'd be more in Argentina, and that could still be potential. And you look at that short term modeling, and it does have some short term deficits for rainfall. But as you looked at the 8 to 14, we're over 100% of normal for all of Brazil and Argentina growing regions. So as of right now, no, there does not appear to be a major reason to be concerned about South American soybean or corn production moving forward.
If you were going to see a crop scare event with regard to Brazil and soybeans, tis the season, like right now. But it's just the forecast hasn't worked out that way. Let's go back to the United States.
So much of the Corn Belt saw below normal temperatures last week, with the majority of precipitation falling as snow. Drought conditions remained largely unchanged across the region, except for worsening dryness in northeastern Missouri and western Indiana. In the High Plains, drought conditions were mostly unchanged, though conditions deteriorated slightly in southeastern Kansas and northeastern Oklahoma. When we look at the percentage of U.S. areas experiencing drought, corn country currently stands at 31%, soybeans also 31%, winter wheat 34%, spring wheat 16%, and cattle country 25%.
Yes, maybe one of the bigger things for me right now would be the river, and river levels on the Mississippi are expected to be back at restrictive type territory here by Christmas or so. And we haven't been shipping very many soybeans out of the Gulf, so it hasn't been a big problem. We've been able to ship corn, and a lot of the corn's been going to Mexico, which goes via rail, I think. But this could be something to be worried about.
Yeah, I mean, anytime we get these low water levels on the river system,
which is every year now.
Yeah, I mean, that it just is one of those things where it throws in the freight cost conversation, and then what type of loadings can we get on barges because of water levels? I don't know that this is getting to extreme levels yet where we're too concerned about it, but just the trend is concerning at this point, and it does make it more difficult to move product through the system when you have these low water levels.
Mackenzie, cattle were up yesterday.
Yep, they had a great day. Live cattle were $160 to $357 higher, and feeders saw gains ranging from $465 up to $502.
I ran out of time to throw a cattle chart in, but what are your thoughts, generally speaking, Brian?
You know what? I thought we were trying to find a little resistance after that $40 rally in feeders. We had kind of gotten back up to those mid-November highs around 340, and we started to see a little bit of slowdown in momentum. Then the cash market just took the live cattle higher, and we gapped higher, kind of in the same spot where we had gapped lower in late October. So I think if we can maintain that open gap over the next couple of days, people will be talking about an island bottom, since we gapped higher around where we gapped lower. And that move yesterday, I think, was a pretty good sign of some ongoing strength in that market.
Brian, thank you for joining us, guys. Have a wonderful weekend. We will be back on Monday.